Netflix is no longer a simple streaming disruption story. It is the scale leader in streaming, it has real profits, it has real cash flow, and the stock has reset from its highs. That makes the question more interesting. Is Netflix finally a buy, or is the market still asking too much for a great business? My FinanceToGo verdict is buy, but not strong buy. Around $87, Netflix is below my base fair value range, so the setup is fair to attractive. But I still want a bigger margin of safety, or more proof from ads, margins, and free cash flow, before calling it strong buy. Three numbers decide Netflix. There are three numbers I would keep coming back to with Netflix: revenue growth, operating margin, and free cash flow. If revenue keeps growing at a healthy double-digit rate, margins stay near the 30% area, and cash flow remains strong after content spending, the buy case makes sense. This is not financial advice. I'm walking through the numbers so you can decide whether Netflix belongs on your own research list. And if you like stock breakdowns that separate great businesses from great prices, subscribe to FinanceToGo and comment the next ticker you want covered. So, what business are we actually buying? Netflix is a global streaming platform. The product is familiar, but the investment story is really about scale. Netflix can spread content, technology, marketing, and product development across a huge audience. That scale is the reason the business can have much better margins than smaller competitors. The newer part of the story is monetization. Pay sharing, price increases, advertising, and better plan mix all give Netflix more ways to grow without relying only on subscriber additions. That is attractive, but it also means the company has to keep viewers engaged enough to accept those prices and add changes. So, did Q1 prove enough? Q1 2026 was a strong quarter. Revenue was $12.25 billion, up 16.2% year over year. Diluted EPS was $1.23, up about 86% year over year. Operating income was roughly $3.96 billion, which puts operating margin around 32.3%. Free cash flow was about $5.09 billion. The simple version is that Netflix is not just growing, it is converting that growth into profit and cash. That's why I'm comfortable with a buy. The caution is that a premium streaming stock has to keep proving this. If the ad tier disappoints, if pricing creates churn, or if content spending rises faster than cash flow, the multiple can compress quickly. So, where exactly does Netflix go well? My FinanceToGo score is 7.8 out of 10. The strongest categories are profitability, cash flow, and growth. Netflix has operating leverage, a strong global brand, and a business model that is now proving it can generate serious cash. The weaker categories are risk and valuation. The stock is cheaper than it was, but it's not a distressed bargain. And the risks are still real. Content costs, competition, pricing fatigue, advertising execution, and regulation. So the scorecard supports a positive rating, but it does not support ignoring risks. What is the market already telling us? The chart is important because Netflix has already had a meaningful reset from its one-year high. That does not automatically make the stock cheap, but it does change the risk-reward ratio. At $87, the market is no longer pricing Netflix like everything has to go perfectly. For me, this is the difference between a buy and a strong buy. Today's price looks reasonable. A price below roughly $80 to $85 would give me a much better margin of safety, assuming the business numbers still look strong, of course. So, what exactly is Netflix worth? My base fair value range is about $95 to $115 in the bear case. If growth numbers are slow and the market uses a lower multiple, I would think more in the $75 to maybe $90 range. In the base case, revenue keeps growing double digits, operating margin stays near 30%, and free cash flow remains strong. In the bull case, advertising scales faster, engagement holds, and buybacks compound the cash flow. I'm not trying to value Netflix to the penny, I'm trying to decide whether the current price gives enough room for the risks. Around $87, the answer is yes for a buy rating. For a strong buy, I would want a lower price or even cleaner proof. So what could make Netflix work? The bull case starts with scale. Netflix has a global consumer habit, a strong content machine, and a product people understand. Bears may be underestimating how hard it is to build that level of reach, engagement, and pricing power from scratch. The ad tier is the extra upside lever. If advertising becomes a meaningful profit driver while the core subscription business keeps growing, Netflix can become more than a mature streaming company. Add strong free cash flow and buybacks, and the per share math can keep improving. Now the hard part. What could break the thesis? The bear case is that Netflix is still a premium stock in a competitive industry. Content costs can rise, consumers can push back on pricing, competitors can spend aggressively, advertising may take longer to become a major profit pool than bulls expect. Bulls may be underestimating how quickly the market punishes slowing growth when a stock still has a quality multiple. The thesis breaker is clear. If Netflix cannot keep engagement, pricing power, and free cash flow growing while competition forces higher content spending, I would have to rethink the buy label. Let's get to my final FinanceToGo verdict. My verdict is buy. It is not strong buy. Netflix is a high-quality streaming leader with double-digit revenue growth, excellent margins, and strong free cash flow. The stock reset makes the price more attractive, and that is enough for a positive FinanceToGo rating. The thesis gets stronger if revenue growth stays healthy, operating margin holds near 3%, free cash flow remains strong, and the ad tier becomes a real profit lever. It weakens if growth slows, pricing creates churn, content spending rises too fast, or advertising disappoints. The reusable lesson is this: a great business gets more interesting when the price resets. But proof still decides whether the stock deserves the multiple. Is Netflix still the best streaming stock after the price reset, or would you wait for a better margin of safety? Tell me in the comments, subscribe to FinanceToGo for more stock breakdowns, and remember, this content is educational only, not financial advice.